Welcome to this episode of Dividend Discussion. In this series, I really want to give every dividend investor a chance to tell their story. We're going to get to hear things like when and how they got started, mistakes made, lessons learned, and much, much more. My ultimate hope for this series is for the guest, you the viewer, and even myself to be able to take something away from this conversation to make us all better dividend investors. No matter if you're retired and living off of dividends or just got started yesterday, there's always something to share and even more to learn. So if you're interested in being on your very own episode, reach out to me via email at dividendobsession@gmail.com and I'll be in touch. But without further delay, let's get to the interview. Hello and welcome to another episode of Dividend Discussion here on Dividend Obsession. My name is Troy and today I have the pleasure of speaking with my 41st guest, SCHD STAN on Twitter, aka Craig. Craig, go ahead and tell the people a little bit about yourself.
Hey Troy, thanks a lot for having me on. I am 48 years old. I was raised in Canada, born and raised in Canada. Now I live about an hour north of Miami in Florida. I'm married with 2 kids. I love to run, work out, watch football, movies, and I'm basically like a dance dad now. I got 2 girls, and I'm every weekend dance.
Yeah. Hey. I actually just went to I guess she's like my goddaughter. I went to her basketball game. I think it was like Thursday night. So I can relate to that. My kid's only 1, so he doesn't have any after school activities yet. So that's exciting. A lot of good times there. Okay. First, yeah. I alluded to this. I have to know, where did the Stan part come from? Are you perhaps an Eminem fan?
I'm not a huge fan, but it's just, people know the Stan from Eminem. Yeah, I'm a hip hop fan. I'm a hip hop R&B fan. So yeah, okay. It's in there, right?
I was hoping it had some kind of connection, and it was not just random.
Does. Yeah, it does.
Okay,
absolutely.
Good. Okay. Yeah, I was hoping for that. I was like, man, like if it's just a random Stan thing, that Eminem's my favorite artist. So I was like, cool. I was like, I hope that's where that's from. So
definitely, yeah. Right? Obsessed fan, right?
Yeah. There you go. So I like it. Okay. Okay.
I'm obsessed with SCHD.
Yeah, hey, I like it. So, okay, first question for you. And you've seen plenty of these, so you know what it is. So, like, when did you begin investing? And then what got you into the dividend side of investing specifically? Like, did you start with dividends or did you kind of wander into it like most people do?
Yeah, so I started like fairly early on with retirement accounts, right? So as soon as I got like a full-time stable job, I started right away, like putting in 5-10% into, in Canada, an RSP account, which is just like a 401k. So I did that right off the bat. I read, I think I've heard other guests talk about the Canadian book called The Wealthy Barber. It talked about saving or investing 10%. So I'm like, I got to do this. And my grandmother came to me. She's like, I'm going to give you money to get this started. You got to do this. I'm like, all right, I've been thinking about it. But when she said to do it, I'm like, you know what? I got to do this. And so that started early on. So when I was probably about 24, I started that, but then that's just set it and never really look at it. Right. So I didn't start investing on my own until 2018. And the other part is, what'd you say about when I started getting into dividends?
Yeah. Like, did you, when you started with your retirement account, was there any dividends in there that made you like think, hey, like what's this random money I'm getting? Or did it like happen on accident?
Yeah. So, well, what the funny thing is when I opened up a brokerage account in 2018 and started doing it myself, I initially, we had sold our house before I moved to Florida, in Canada. So I had some money, right? And I was like, I want to invest some of this. Our mortgage had a low interest rate. So I didn't want to put as much down on the mortgage. I wanted to invest it. So I had a good chunk of money. So I was like, how can I be safe with this? I don't want to just throw it out there. I know how dangerous this can be. I was learning. So I actually looked for safe investments. So actually one of the first stocks I picked was SCHD, which is just, it was crazy. So I was looking for something like I read about the S&P, like how like nothing really beats it. I read a few books, like it was even a Tony Robbins book, like Money Master the Market or something like that. So that might have been the title. I think that's the title. But he went through all these different things, and he's like, basically the conclusion is like nothing really beats the S&P, so why not just invest in it? Mm-hmm. So I was looking for that type of investment, which I had done. I had put a ton in my my RSP into that too, which is again the Canadian 401. So I ended up finding SCHD on Schwab. I opened a Schwab account and they had like free trading on some select ETFs. And it was one of them. I did some research. It kind of had like a little dividend, some growth. Like it was a little bit of everything. I'm like, this seems pretty cool. So I put some money into it. And later on, I got into, in 2000, late 2020 is when I really started investing, because I just set that up again and kind of just forgot about it. And then 2020, like everybody else, we're, at home and it's like, okay, what can we do? And like everybody else, I got into all sorts of stuff on like SPACs and just, it got, things got a little crazy there. But in 21, when I started feeling like this is getting a little crazy, like this is too good, I went back and I really looked at SCHD and some of the dividend stocks I had happened to buy. And I was like, these ones are really holding up as things are starting to come down. And look how great SCHD is doing. Like I look at my first shares of SCHD and I have it written down. This is one, I know you ask about this all the time. It's like one of the motivating factor. I'm jumping ahead a little, but something I always do is I go back and I look at the first shares of SCHD that I bought. I bought 10 shares my first purchase and the share price was $47.50. And now it trades for, $78, $77, right? And that was in 2018. And my yield on cost for that is, so it's up 64%. It's not, the S&P is up a lot more, but my yield on cost is 5.63 for those shares.
Yeah.
So that's the yield I'm getting for that money I put in. So it's always a reminder to go back and like, wow, look at this. And then look at all these other individual stocks I picked, and they're not, some of them are way down. Some of them are not doing anywhere near that. It's like, it keeps me motivated to say, when you look back over any few year time frame, things are usually looking pretty good if you made a good decision in the first place, right?
Yeah, I think that is wild, and that's a really good takeaway that you just mentioned about like you didn't. Now it's an ETF, so it's a little bit different, but like even some of your individual dividend stocks that you picked, you weren't out here waiting for it to go down by 6 cents so you could feel good about yourself when, you got a deal on it or whatever. You just identified a good company that you wanted, you bought it, and then years later you look back at it and you see the fruits of your labor. I see so many people, miss the boat or miss the opportunity because they want, something's $52. I really want it at 51.45, and then, it never goes to 51.45, and they miss out on hundreds or thousands of percent gain for a couple cents here or there.
The best thing I could ever do is that when I started in 2018, I barely looked. I would buy and just shut it down and not look again for several months. And then like 6 months, I'd go back and go, oh, wow, look at that. Yeah. Look how smart I am.
Yeah.
It's not really that smart. It's just, it's being patient and just, waiting it out. And like, and I look back at any of the stocks I invested back then. Like I worked in internet marketing. So I bought Facebook, and it up and down, but over a long periods of time, it's done amazing,
Yeah.
I made mistakes too. We'll get into that. So.
Yeah. Hey, and you're getting a dividend from Facebook now. So look at you. You knew ahead of time.
Finally, after all these years.
Yeah. That's pretty cool. So I do have before we get into the next question, I have like a unscripted question. So you were mentioning that your grandmother wanted you to invest. You had ideas of investing when you were young and in Canada. And then like you knew like as far as when you moved to Florida that you knew about the interest rate and like not putting so much down and stuff like that. Where did that come from? Was that like how you were brought up, or did you like stumble into some of that stuff? Was it common sense to you? How'd that come up?
I read a lot and listen to a lot of, back then, not too many podcasts and stuff. So it was mostly reading, but yeah, just always trying to learn and improve. And I'm really big on that. So I try to, before I get started in anything, I try to take in a lot of information. But then at the same time, don't not get into it. Like the best way to learn is to do it. So you got to do a little bit of both, right? So you kind of got to jump in, but don't jump in blind.
Yeah.
So yeah, like I read a lot of books, like, and that really helped. And then I even remember when I was a kid, my dad told me, people always talk about what would you do if you won $1 million, right? If $1 million was handed to you. My dad said, well, put it into an account and get interest.
Yeah.
Like, what? What are you talking about? Like a little kid, right? And I'm like, what's that? He goes, well, if you got 10% interest on that, and this is back in the day when you could, I'm 48, right? So back then you could find something with good interest. He's like, you get 10%, you get $100,000 a year. I was like, and to me, I'm like, $100,000 a year? you don't have to just put that money away and then have fun, you know?
Yeah.
So it's like, that stuck with me forever. And then when I started learning about all this stuff, that still was always in the back of my mind. And so again, when I had that money from selling the house, I was like, let me do something that's going to pay me, regardless of the stock market, up and down. It's going to pay me something. So no matter what, I'm still ahead a little, you know. Even if it goes down, I've still got something. I can't lose it all because they're giving me something, right? That was kind of the thought process, right?
Yeah, I mean, I like that. So I because I'm not a giant reader. Like I don't know. For whatever reason, I can't focus long enough to read. But I think the important thing is just like absorbing the information, whether it is a podcast or videos on YouTube, or it is reading, or even if it's on different groups via Twitter or via Facebook or whatever it is, like just absorbing information. Obviously, don't take anything you hear from anybody for face value. One of my bosses, when I was first moved to Oklahoma, he had a saying, trust but verify. And that's just stuck in my head all the time, where it's like, okay, cool. Like when you watch my top 5 series on Friday, you can trust that I picked good stocks and this and stuff. But I never, like I even tell you in the video, my intent isn't for you to just say, oh, Troy said it, it's a good stock, buy it. That's never how it should work. Like do your own research and stuff like that. So, so another off scripted question. You said that you have 2 daughters. How old are your daughters?
They are 8 and 12.
Do you have any kind of investing accounts with them, or have they showed any interest in the investing world, or how's that working?
The interest will get there. If I talk about it enough, maybe they'll catch on. I've learned you can't push things too hard because sometimes they want to push back. Yeah. So I just talk about it and I try to make it fun. And I'm still learning. I'm trying to figure out ways. But I did open an account. It's in my name, but I have it named. It's for them. Mm-hmm. So I didn't want to get into all the custodial stuff, which is fine. You can do that, right? That's great. But I just opened up accounts and I said, I didn't want to have to figure everything out or whatever. And I like having full control over it. And I almost like the fact I don't have to give it to them at 18. It's mine. I don't even have to tell them they have it. Mm-hmm. So they won't think, well, I've got this money to fall back on. I don't want them to be spoiled like that, right? So yes, I've opened accounts for them in my name. And I slowly talk about it. I don't get into too much detail because I don't want to bore them, but I do talk about them. And I like to show them wins that I've had on the market and talk about how, what companies do you like to shop at? Like, what do you like to buy? Let's look at the stock. Like, hey, did you know this? Like just little things like to get them excited. I'm like, if you have, so you like that company? Like I'm trying to think of a like Ulta, right? My 12-year-old likes Ulta where you buy makeup and stuff, right? And I said, look, well, if you put $1,000 into Ulta last year, it would be worth X now, right? Like it's up 20%, whatever, like stuff like that. She's like, oh, that's interesting. So, and I'm like, well, every time you get money for your birthday or whatever, well, if you didn't spend all that and saved half of it and put it away this year, and then this is what it'd be worth in 5 years down the road or whatever, stuff like that. Oh, and she's starting to get it now because she likes to buy things. She's like, wait a second, I want this, I want that. I want to go hang out with my friends and I want to be able to buy this sweatshirt, and like she loves clothes and stuff. So she's starting to understand that, this money stuff, it can do things for you, right?
Yeah. I wonder, cause obviously like we were talking about pre-interview and I've talked about before, like my kid's 1, he's like 15 months or whatever math you want to do, but actually he's turning 16 months tomorrow, but he doesn't obviously know any of this stuff, but I wonder have you ever heard the story of, or I don't know, it's not really a story. I mean, I guess it is, but have you ever heard the story of like a person that like has a paperclip and they progressively trade it into bigger and bigger things?
Oh, yeah.
I wonder if that would be something like I could use or you could use for your kids. Cause what that symbolizes, like you just tell them the story and like, I think they ended up trading like a paperclip up to like a house or something like that. And like what you could do is like, as you're talking to your daughter about like, when you get money for your birthday, you save half of it. It's like, okay, so you save half of it and then this money makes you money, which gets you a chance to make to earn something. It's like the delayed gratification. So it's kind of teaching, like holding on to something like, yeah, this is cool, but this other thing's cooler. And then once you get to that thing, that's really cool, but this other thing's even cooler. And then like you keep building it like that. And I wonder if that's a good way to like illustrate it to kids. Cause like, I've learned just in like talking to people that have kids, like kids have no understanding of like tomorrow. Like that tomorrow doesn't comprehend in their head.
A lot of people forget kids.
Yeah, like, you're not wrong. Yeah, some people never have an understanding of tomorrow, but like kids especially, like when you're like, hey, Because I have a video, like I was talking about before the interview. I have a video idea. I'll tell you about it after we're done here. But it's basically just illustrating the power of the compounding multiple of like starting very early and then like how it gets progressively harder as you go without starting. And like just a video like that, I'm gonna try to make the younger version video more geared towards like entertaining the kid, but being informative to the parent. Because obviously, if you like, for me, I have a 1-year-old. My 1-year-old's not like, "Hey, Dad, here's 25 cents I found. Go invest this." Like, he doesn't know any of those words. So, but like, yeah. So it's just an idea for that. But I thought that was really curious that you had like the wherewithal, because like people at the end of the day, they don't have the idea of retirement and investing until, like I said, it's not too late. But like they do it when it's like they're making it so much harder for themselves.
Yeah, I think you know what's helped, like people like me and you, like you like to work out.
Mm-hmm.
I like to work out too. Like you see what being committed to something does for you and how you get better over time and how much you progress when you don't you're not looking at things by the week, you're looking at it by the years.
Yeah.
You know, you see the difference that you used to be able to lift this. A year later, you can lift double that because you worked out 3 times, 4 times, 5 times a week for that whole year. You don't be like, oh, I worked out twice and well, how come I'm not stronger yet? Like it doesn't work like that.
Yeah.
You know, so it really, if you can carry that over, that's what it's all about.
Yeah. I didn't obviously do this from the beginning. Like I wasn't able to connect the two, but like I've had a couple people on the show and then like I've just thought about it on my own, like working out and investing, but specifically dividend investing, I feel like go hand in hand. Not that you need to do one to do the other or whatever, but like it helps you relate so much. Cause like you're talking about, when I first started, I remember 2012 is when I started lifting. I was at Planet Fitness. And I just did the Smith machine because they didn't have free bars. And the Smith machine is 25 pounds. It's counterbalanced. And I was doing the bar. And then fast forward, I think it was 2 years ago, 2 years ago, I have the Oklahoma State record for USPA for bench press, like 336 at 165 body weight. Like I double body weight bench pressed. So like, it's one of those things where like you have like, and the cool thing with how it relates even more to the stock market and like dividends is like, I'm going to have days where I get hurt. There's a market crash. I have days where I'm just not as strong. I didn't get good sleep. I had bad stress, whatever it was. And like you go into the gym and you're just not feeling it that day, but you're still there. You're, in other words, you're still investing in your body or in your portfolio. And then you're going to have days where you feel really good. You got good sleep. There's no limited stress in your life. You ate a really good meal or whatever, and you're really strong. That's a really good day in the market. So it's just constantly going back and forth, and like you have to experience the bad days. That's when you add. You have to experience the good days. That's when you feel good about yourself. And the combination of the two, it's stacking day over day over day over day. And like I don't even remember my random bad day I had in February 6 years ago. And that's the point of the market too. When there's a random day where it goes down 1%, yeah, when you're looking at the chart on a 30-day basis, you can point to it like, oh yeah, there's that day that it was real bad. When you zoom out to a 1 year, 5 year, 10-year basis, you can't even find it. And that's the point. Exactly. It's like sticking with it. And like I think it, like I said, like you said, it relates to fitness so much. And if I do think you do have like a competitive advantage if you're at all into fitness. And you're into investing, I think that if you can tie those things together, you can really see how it comes together. So I like that.
The other story I told my daughter, and I'll tell it again because you have to keep reminding them. Have you ever heard the one of the lily pads covering a lake?
I've heard of it, but I don't remember that story.
So basically someone asks, so in 30 days, this entire lake, doesn't matter the size, will be covered by lily pads, okay? In 30 days, completely covered because the lily pads are growing a little bit every day, okay? What day, you don't have to answer because I know you don't love the math. Yeah. What day, it's a thought thing. What day will the lake be half covered if every day the lily pads double? So the amount of the covers doubles every day. So you start with 1 lily pad and then and 2, and then so doubling all the time.
It would have to be like so if it's a 30-day process, like I would my logic would tell me it'd be like day 27 or something, day 28.
The second last day. So if it doubles every day, if it's full on the last day, the day before you're only half.
Yeah. I mean, that makes sense. Yeah, like it has to be late
right?
because
So
like
you're
the
onto it. You got it, man. You got it. Pretty much, you
woo,
got it
I was
right.
told there'd be no math, but I figured it out.
Right? You
That's
can
pretty
do
cool. Yeah,
it.
I mean
But
that
isn't that
makes
amazing? Think about that.
yeah, yeah. I mean it's the same thing with
An
like
entire lake. It doesn't matter how big the lake is. The entire lake, it's going to be covered. And the day before it is not, because it's doubling every day.
yeah. I mean that's the same thing with like when people look at like share those bar charts and stuff with like Warren Buffett's net worth and stuff. How like
Mm-hmm.
90% of it's come in like the last 10 years. And then like
Exactly.
10 years from now, if Warren, is still kicking by then, he's going to be he's already very old, but he'll be very, very old by then. But like what he made like 3 years ago will look like a drop in the bucket to what he's going to make 10 years from now. Like it's just like the compounding. And that's like dividend investors really get to appreciate that because not only does your portfolio compound is like, if I have a $10,000 portfolio and you have a $100,000 portfolio, we both make 2%. Like big difference in how much money you made versus I made. Like it's a big difference and that's how it works. But the dividends are even crazier. Like it's just like, okay, Coca-Cola is going to pay me, $100 this time, and then 10 years from now they're going to pay me $1,000 in dividends, which just gets added back in and all kinds of stuff. So
And it can't that percentage can't get taken away. You've got it.
Yeah.
I mean, you can waste it, but it's given to you. The stock price can go up and down, but that dividend paid is yours.
Yeah.
And you can compound that. It's incredible.
Yeah. I've said before, it's almost like at a certain point, so I don't know if you see my monthly recaps and stuff that I post. Like I said, I have one at the time of recording. This comes out. Your interview will come out like the middle of May, so the recap already been done. But for your sake, my recap comes out on Monday. I'll probably put it out like Monday at noon or something like that. But I have a chart in there that tracks my dividend snowball, and it just tells me the amount of time it takes me to get the different milestones, whether it's $100, $200, $500, whatever it is, the amount of time it takes. And it's just crazy to see like the compounding of that, of, just getting more and more money quicker and quicker and quicker and quicker. And then, it just adds with the drip, you get more money. And, it sounds like a made up thing. It sounds like the dividend folktale, but it's true. I mean, at that point, once you get to the portfolio being big enough, it's almost like you have two people working on your portfolio. Or if it's a husband and wife and you already have two people, it's now like you added a third person working on your portfolio.
Yeah, it's really great. Yeah,
so I like that. Okay, anyway, that was a long thing we just did there. But okay, so next question for you is, what would you say is your biggest dividend-related mistake? And more importantly than the mistake is, what lesson did you learn from making that mistake so you don't do it again?
Yeah, so as far as dividends go, like, so I got to the point where I was thinking like early on where like that all dividend companies are safe. So these growth stocks can be dangerous, right? I learned that lesson. So these SPACs, I don't want to get involved in these startups. I don't want to get involved with them anymore. But these dividends, no, these are safe, right? So I started falling in love with like any company that paid dividend. I started looking at, so whenever I was listening to, basically the biggest mistake is listening to too many people. You got to hear, you got to take it in, but like you said, you got to verify, right?
Mm-hmm.
Listen and then verify for yourself. Because, I thought I was listening to, and they are even experts. They are experts, but you don't know their point of view. Information changes. You don't know their trading style. Some people are looking to trade in a month, in a day. Like they're saying it's good because they see it going up in the next 30 days, but they're going to get out. Once it starts going down or whatever, once they don't see what they like, they're out. But we're thinking long-term, we're like, oh, okay, that's a good buy. I'm going to buy it. And then we hold it for 60 days, for longer. And it doesn't work out the same way.
Yeah.
So there's so many things involved in what anyone's saying, and you don't know every aspect of where they're coming from. So you really have to go and figure out what you're trying to do, and does what they're saying fit what you're trying to do?
Yep.
And do you know more about something than they may? Like, for instance, if you ever listen to anyone talk about a topic that you know very well, and you can tell they know a little bit, but they don't know as much as you know, and you're like, oh, wow, they're so off. But you know what I mean?
Yeah.
Like, think if you hear somebody talking about weightlifting or something, and they know stuff, but they're fairly early on their journey, and you're like, oh, he needs to so wrong.
Yeah.
Right?
I can tell that when people ask me like certain questions at the gym, like it'll be, a kid, he's 18, whatever. And he'll ask me like, you can always tell where they are in their journey. If the first question they ask me is what supplements are you taking, I know where they are. Like I know supplements don't make that big of a difference. Like take your creatine, hit your protein, like eat good foods. Like it's not that difficult. But like kids will ask you that. But then if kids are saying, hey, like, do you prioritize compound lifts or accessory lifts or like like when they start formulating questions to your point like that, then you know, oh, okay, I can talk to this person a little bit different because I know where they are in their journey.
Right. So all it takes is a few times of hearing an expert talk about something you know very well, like your industry, your something you spend a lot of time studying, and you're like, oh, they might not be completely wrong. They just interpreted that data point so differently than I would have. And then you realize, okay, how many things don't I know that I hear other people talking about where I just trust them and I just believe them? Everything out there. Once you dig into the weeds, you start to have your own opinion and be like, well, I wouldn't interpret that way. Like, so you really need to get the information fresh for yourself or from experts that you know more about their background. You know where they're coming from. You know why they said they didn't like that. Is it political that they didn't like it? Is it, something burned them in the past? Something like they're a trader. And most people on TV, whether they say it or not, they're traders. And they're also trying to say something that's going to grab attention. So they're not going to talk about the boring stuff. They're going to talk about stocks that are hyped up and flying. And oh man, we were talking about mistakes, right? Dividend mistakes. So I listened to too many people, like even good stuff, like Jason Faber. I don't know if you ever listened to him. He's good. He talks about dividend stocks. He really got me interested a lot in dividend stocks. But I would fall in love with every story he told. And I'd buy a little. Let me buy a little of that. Let me buy a little of this. And I ended up with a ton of stocks, too many. So, and then it was okay. I learned from that though, because I started to identify the good ones and the bad ones and what I liked and what I was looking for. And I started to figure out what to avoid the next time, and even the ones I don't love have some of them have been okay. So it's not all bad, but yeah, even dividend stocks aren't safe. And of course, everyone talks about the chasing yield. And I think everyone who starts dividend investing gets into AT&T, and I did too, right? Yeah. So I learned that lesson.
I think that's both of those things are so important. The chasing yield, I feel like, is a given. I feel like you're an anomaly if you're a dividend investor and at one point you haven't had the yield thought. Like, wait a minute, I can put $10 in this one and get $5 back, or I can put $10 in this one and get 50 cents back. Like, why would I want to do that? So, and then I feel like you can almost take information from anybody. But there definitely is levels of trust, right? Like you have to be able to trust the person, which lets you know. Honestly, I don't even know what I'm trying to think about is like, if you get information from anybody, because getting the information isn't the bad part. It's what you do with the information that is good or bad. So like you can literally watch as many YouTube videos, look at as many articles, watch as many commercials, listen to CNBC for hours a day if you want to. Like that's not necessarily the bad stuff. It's just like, what you do with it, like how the process that you have or lack thereof to filter out the information that you are receiving and only bring back the good stuff. Like that's the part. So my recommendation there, not financial advice, whatever, but like my recommendation there would just be like, if you have yourself some good filters in order to find the things that you're looking for, whether it's criteria you're picking your stocks by or anything like that, you can listen to as much as you want. If you don't have good filters and you don't trust your filtering, be careful what you listen to, because you don't have a good process, like a good filtration system. You don't have a good filtration system to catch all that stuff, and you're just going to get a lot of stuff in your water that you don't want. So
exactly, because that helps you see. So you hear somebody talk about a stock, you put it through your filters, and you're like, oh wow, this is way off on this aspect. Like, look how poorly it's done it's just doing well right now. Like it hasn't done well over the past. And it's, payout ratio is way, like they're paying out way too much of the money they make. And you're like, okay, well, he is in it for something else. Like he's looking at something else. Like, exactly. I'm starting to see.
Yeah, because you always have to wonder, like, there's a certain guy on YouTube, I won't mention him, he knows who he is. I've commented on his stuff. I don't appreciate the content he puts out, but he'll post stuff, and like, he has a certain goal that he's trying to achieve with his videos, and he has really good charisma and stuff, so people like watching him, but like, you can clearly tell that some of the filters I value and I think other people should value, such as like trying to get the most money for your stuff. Like, right, I don't want my stuff, even though it's paying me a dividend, I don't want my original investment to disappear. Like, that kind of defeats the purpose. So like, he'll share stuff like that all the time. And I'm like, okay, I don't agree with his method, this, that. But like, you can clearly tell things that they are and are not filtering for, or they don't care about as much as you do. And that's not to say, to kind of speak on both sides of my mouth, that's not to say what they're investing in is wrong. It's just not right for you. And that's the most important thing. So
there's a lot of people, and most people in media are riding trends because the trends are what people are looking for. So it draws attention. The trend is what makes you money in the short term. And when you've been doing this for a while, you see that there's cycles and the trends change. And everything trendy is working until it doesn't.
Yep.
And it's good to prepare ahead of time for when that trend shifts, or be long-term enough to know that when that trend shifts, if you really love that company, and you've done your research on it, I'm okay with it dropping 50%. And knowing that this is an opportunity and it's going to come back.
Yeah.
Because people that got into it for the trend often are the first to leave when things go wrong. And like SCHD is a perfect story. When everyone loved SCHD in 2022, when it was beating the S&P, it had all the hype, and then it started to lag, and now everybody started hating it. The trend people. There's people that know better. But I'm talking about the people that are on it for the trend. They got into it for the hype. So when the hype's gone, they're like, oh, this sucks. It's over. Like, hey, there's cycles like this.
Yeah. I mean, I've talked about that a bunch on the channel about like, even when you're picking your stocks, when you were talking about like Jason Faber, and because I bought, I don't know if I even shared this on the channel before, but APD is Air Products and Chemicals. He did a video on that years ago. And like my whole research was just like, he basically brought up the things I cared about in the video that like made it sound like a good buy, and I bought it. And it's like, I think it's one of my bottom performers. But it still continues to meet my metrics and stuff like that. But I would have never bought it had I never seen that video. Nvidia, I bought a long time ago when I joined that dividend group I was talking to you about on Facebook. But it didn't meet any of my criteria. So when I sold it, of course it goes up after hours. I told the story before, but, it's just about like, I think that's like the smartest thing is, and we'll probably get into this later about like, you can buy, like, just having filters and criteria that you can set all your stuff through is such an important, like, that would be my biggest thing I would tell my younger self when I first started dividend investing back in 2020 is just like, don't like, because I get informational paralysis. Like, I'll just like want to know more, and then I don't make any moves. So like what you were talking about earlier is like, there's a fine line between like knowing things and then like not making any moves because you feel like you don't know everything. You're never going to know everything. So having those filters, I think, is such a big thing. And like over time,
something to lean on, something to just cut the noise out, and you know what? And sometimes you're going to miss some stuff, but that's okay.
Yeah.
I say it all the time. You don't need to swing at every pitch in investing. You can just sit there and wait for a great pitch that you like to hit. It doesn't even have to be a pitch somebody else likes. It's you like it inside and low, whatever, low and outside. That's your pitch. Wait for it. You can wait long.
Yeah. Yeah, you do. Yeah, that's exactly right. So I agree with all that. So, so next question for you. So you talked about in 2018 buying SCHD and then getting back into it in 2020, and getting into basically what everybody was into as far as like just this is the next thing. Basically in 2020 and 2021, you couldn't be wrong. Like you just kind of picked anything and anything went up.
That was dangerous.
Yeah, it was dangerous because I have a bunch. I think I've told this before in interviews. I've had so many people that I'm just like friends with on Facebook that are anti-investing now because of that. Like they are investing's a scam, this and that. And I'm like, no, you just bought when you thought like when everything was good. And then now like you had no reason for buying the things you're buying. Then it goes down and you think investing's broken. It wasn't your style. It wasn't your method or lack thereof. It was investing. And I'm like, that's like, there are hundreds of thousands, millions of people that invest and like, it's just broken for you. Like you don't see that there's a little disconnect there. Like I don't understand. So with that being said, how would you say from 2018 till current, how has your investing style changed? Do you do more individual stocks, less individual stocks, look for certain things in your stocks that you never used to? How's that work?
Yeah, well, I mean, like we've been talking about, I've really learned that you can borrow somebody's stock idea, but you can't borrow their conviction. So you get a great idea from somebody else. Awesome. It's doing great. Whoa, I'm like, this is greatest. But then when things get rough, you don't have whatever made them buy it, which they know is still true. You don't know. You're like, you're like looking for more information. Where's that guy? Is he talking about this stock anymore? And he's not talking about it anymore because it's not trendy.
Mm-hmm.
He's holding on or not. Maybe he got out. And you're like, what do I do now? But you have nothing to fall back on, right? So I've learned you got to find your own convictions. Start using filters. And like one of the things I learned from SCHD is that SCHD uses filters to pick their stocks, right? The index, I mean, they follow an index. The index actually picks all it. Schwab just blindly follows it. Like they're not doing anything special. They're following an index. And they use filters. And I listened to the people, I read the little book that beats the market by Joel Greenblatt. And he had like 2 filters. You know, it was like P ratio and return on invested capital. He's like, over the time, he's like, you want to buy stock when it's cheap, like low valuation, and that has quality to it. And he's like, how do I measure quality? He's like, let's pick something everyone can find, return on invested capital. How do I find value? Let's just pick P. And he did a million different back tests, right, to figure out what are all the things. And that was the simplest one he could find. And over time, this beat the market. So I started looking at that. I'm like, how can this work? You know, all these filters. Everyone I heard talking about filters, this really helps. So, you know, and I hear yours too. And like, anytime you come up with a few different filters, it really helps the process. And those stocks tend to do well. And like we talked about, you'll miss stuff, but you'll also, you won't get hurt by a lot of stocks as well.
Yeah.
The other thing I learned is like, it's really hard to beat the market. It's really hard to beat good ETFs. So I try now to invest less in individual stocks and more into ETFs, and only invest in stocks when it's something I love, something I understand. It's something that has really solid metrics, and we'll get into which ones we like. And when kind of the news on them has gone bad, but there's still nothing's really changed internally, or the short term, it's one bad quarter, but it's still a great brand. It's still a great company. In the long run, you feel that company's going to be okay. And I know I have that conviction because it's worked for me in the past. You know, people say don't catch a falling knife when something's dipping. And yes, there's some value to that. When something goes down, like wait, like don't panic either way. Don't panic buy, don't panic sell. But I'll tell you what, most people that talk about don't catch a falling knife, they're not long-term investors. They're not thinking 10, 20 years out. They're worried about that money within the next year. So they're like, I was up 20%. Now I'm down 10. I need to get out before I'm down 20, right? But if you're long-term about it, you can go down 20. And if that company's good, you know they're going to come back, or you have a really strong feeling they're going to come back, buy more. It's okay. So again, you gotta think about what the point of view of people are coming from. And most people in the media are riding trends and are short-term thinkers and are trading, and they don't want to get beat up for talking about a stock that's not trending well, that's on the down. The bad news starts coming out when the stock price goes down. It's not the other way around. The news doesn't drive the stock price down for the most part. The stock price goes down, everyone tries to rationalize why it's down. Oh, it's the first thing ever, blah, blah, blah. You know, Starbucks right now.
Yeah.
You know, when something's flying high, no one can say anything bad because they don't want to be the guy who says something bad about NVIDIA who's killing it.
Yeah.
You know, whatever. But all those things are only good until they're not, right? The stories change. And then the trend will be like, oh, I thought this long time ago, I knew NVIDIA, blah, blah, blah. I've heard people you can hear it mentioned now. They've pulled ahead all this growth from years ahead. People are buying up all the chips now. All the big companies are buying the chips. Later on, they're going to start making their own because the margins are so high. So it's already starting to get built in a little bit. But when the stock really goes down, which it will, people will be like, oh, I knew all along it was bad and we should have seen this. Every time. It happens every time. Chip stocks are so cyclical. They go up and down like you don't believe. And when they're up, everyone's like has FOMO and wishes they were in and is riding high if you did buy. And it's just they'll come down, they'll go up, they'll come down, and you just don't know how long those cycles are going to last. That's all.
Yeah. I mean, you brought up a bunch of really good points in there. And like the one thing about like the catching a falling knife, to kind of reiterate your point, is like investing's all based off of how many shares you have at your cost basis. That's quite literally what it comes down to. So if you like, when I buy my companies, like I buy every day, and I want to, ideally, I would be lowering my cost basis, and as it goes higher and higher, say my cost basis was $75, I can buy more to get it down to $70. And then 30 years from now, it's worth $140. Then I made more money to have it at $70 than I did at 75. So when you're saying like, don't try to catch the falling knife, and those people are typically in it for shorter term, like at the end of the day, if you can buy a company that you have really good conviction in, and again, this goes back to like understanding what you're buying and why you're buying it. If you can buy a company when it's down 20, 30%, and you can lower your cost basis by $3, $4, $5, $6 a share, something like that, when it does come back, it can come back. So say your cost basis was 75, you buy it, your cost basis goes down to 72. Now your break even point's $72. If it gets back up to 75 where it was the first time you bought it, you're plus $3 a share. And like, that's literally all like investing's very complicated. There's so many metrics you can look at, but there's also like you can get rid of a lot of it and just focus on certain things. Number of shares times cost basis. That's what you're in it. Anything more than that is profit. That's money in the bank. So like, it's that simple when you're buying. Do what?
I was going to say, it is really hard when a stock is down and there's all this bad news and noise everywhere. Because sometimes you're right. Like sometimes there's been a huge change, like a real change to the way we live life. And it's not going to be, the growth is not going to be there in the future. And something has changed where they don't have their competitive advantage that they once had. But you have to sift through that and figure it out. And that's why it's not easy. And that's why like ETFs might be the answer for a lot of people, because it's tough.
Yeah, I do. I think ETFs are like, to me and you, we enjoy the process of updating our portfolio, looking at a spreadsheet, this and that, and like seeing more and more shares. And every time you buy something, your patty goes up, and like we enjoy seeing all that stuff. So like, and you're even doing that with ETFs. You can do that with ETFs, where if every day or every week or every month you were to buy VOO, you can track the same stuff I'm tracking. You can track the yield, you can track the patty, you can track all these numbers. And as you make your purchases, you can watch all that stuff go up. You can ignore the stock price. Don't even worry about it. Especially with ETFs, I've never heard somebody say, I'm waiting for, well, I guess I have heard this. I don't know why I've heard it, but like they're waiting for a certain price for an ETF. That's literally not the point. Like the point of an ETF is a basket of funds. It's instant diversification. You buy this thing for diversification across many sectors, industries, all the things. But like some people are like, oh, I'm waiting for the S&P 500 to hit, the VOO to go down to 400. I'm like, it's the S&P, like just buy it. And then as it goes down and as it goes up, you just keep doing your thing and don't like, I feel like they're overthinking things that don't need to be overthought, if that makes sense.
Yeah,
so
it all depends on your stock, because I do a little bit of both. Like I have, no matter what, I'm investing like a good chunk into the S&P every month, every paycheck, right? It's going in automatically. So everything I say about stocks and anything, you got to remember that I'm investing no matter what, right? But then with my own brokerage account and individual stuff, I'm more picking and choosing. So I will wait for prices, right? But at the same time, I'm dollar cost averaging as well.
Well, yeah, so I mean that more from the perspective of like the people that are like, oh, here I'm supposed to invest $2,000 this month. I think the market's overvalued. I'm going to hold $2,000 and I'm going to save it until the market goes down. Yeah, because like what happens if it's what was it, 2013 to 2020 was like one of the longer bull markets in the thing. And like I guarantee you go on Google right now, you can find an article written in 2014 about how something's going to crash, which is going down, all the things.
Oh, every day.
Yeah. So
every day. Yeah, the entire time they're like, the crash is coming.
Yeah,
the crash is
Yeah,
coming.
every year you just recycle it. Nobody ever remembers the take of the guy that said this crash was going to happen, never happened. This crash was going to. That's why, like, anytime, friend or not friend or whoever it is, anytime somebody makes a wild prediction, I always say, give me an expiration date. Like, it's not like you don't get to make this prediction that the market's going to crash 20% and it just lasts forever and eventually you're right. Like, that's not how this works. Like, what? Oh, really?
You're a genius. You're a genius when you get it right.
Yeah,
You've been saying it every year since 2000.
yeah. Don't worry about the 9,000 predictions I made before. This one I got right. Look how smart I am. Here's my book. Buy my course.
Like, Literally, the market goes up 70% of the time.
Yeah.
So you're much better off being optimistic and getting your money in.
Yeah.
Right. And there will be dark days and there'll be dark times. But like you said, when you look back over time, it ends up being a blip on the scale because 70% of the time we're going up and to the right.
Yeah.
So get on, man.
Yeah, I tell people that all the time. Like I see so many people on the groups and stuff like that where they're like their whole investing philosophy is based on like waiting for the perfect time and waiting for the crash and this and that. I'm like, what? You're planning for like the thing that happens the least amount of like what? Yeah, it's a great opportunity if you can time it right. One, if you can time it right. And then two, like it's the opportunity cost of missing it. Like I was just talking to one of my subscribers via Facebook Messenger earlier this week. And I was just saying about like when you have a stock that goes, it'll go up for a week straight. You're like, I don't want to buy it. I don't want to buy it. I'm waiting for a dip. It'll go up a week straight. Let's just say it goes up 10% in a week. It has a really good week. The next week, it'll go down 2%, and everybody's like, ooh, a buying opportunity. I'm like, it was substantially cheaper last week when you were waiting for a dip, and now you get a 2% dip. It's still more expensive than it was, but you feel good about yourself because you bought on a red day. I'm like, that's the psychology of the market.
Yeah. Yeah.
People do that all the time.
I do a little bit of it too.
Yeah, like you're just everybody wants the deal. They want to see the little red side when they buy it. They're like, "Oh, I'm getting a deal." I'm like, "Yeah, but if you would have bought, you had the money. It's not like, oh, okay, I didn't have any money or whatever. Like that's different. Like that's my boat. It's like Tesla will go down, I'll add money to it, then it'll go down again. I'm like, I'm out of money. Like I can't add anymore. But just stuff like that. So I mean, I don't know. It's one of those things when I'm just like, that is the psychology. And when you actually step back and like you can start, I want to make like a video called like the psychology rule book or something like that, where it's just like the common things that investors face and what I do to, because I'm really good at like taking the emotion out of it. Like I can find a good thing or a bad thing in anything. And like that's another question I wanted to ask you. With you being such a big reader, have you noticed, and this will relate to other people that are big readers, have you noticed in like all the books that you're reading, are there things that you're finding in common in these books? Or worst case, are there things where you're finding one book where they're really good at arguing one specific thing, and then it seems like the next book you read it like counter argues the book you just read? Like, what do you do with that information?
Yeah, well, I'm big on taking in a ton of different perspectives and then mashing it all together and figuring it out for myself. Because I always feel like, especially with media and news, like the extremes get the most attention, and the truth is somewhere in the middle, right? So I'm always trying to find like my truth in the middle there, and my truth from my perspective in my world. Like everyone's got their own goals and needs, and so we're all different. So you really need to figure things out for yourself. So yeah, I mean, but when it comes to investing, there's tons of commonalities, and it's really all about the psychology when it comes down to it. Like it's not panicking when things get bad, because they will, but the bad times don't usually last. Like we figure things out. Like this country, figure things out. Like we always have. Like this, you ever heard the quote, necessity is the mother of invention?
Yep.
It basically means when the crap hits the fan, that's when we really figure it out. So we'll have all these problems like floating over us, but we won't commit to any of them until that is the thing that's going to kill us.
Yeah.
When that thing is right in front of us and the train's about to hit us, okay, now we got to figure out how to deal with this. And we put all the money into it, and boom, boom, boom. Amazing things happen. Like, so that's why I'm shooting, like setting these crazy goals, like, let's go to the moon. And people are like, why? We go to the moon because all the technology that you built to get to the moon is why we have smartphones and computers and why all this stuff exists now. If we didn't try for the moon, we had nothing to push us to do that.
Well, I mean, the sad part, and I'm just thinking exactly about what you're just talking about. Like, the sad part is you would like to be more proactive than reactive, but when you get certain things get so big, like they almost feel no threat until there is a threat. And then they show you the power of being as big as they are. For instance, like I obviously way before my time, but the space race, if it was just the United States, like pretend no other country cared about going to the moon, we'd probably still be waiting to go to the moon. Like Elon would have come by and be like, hey, let's try to go to the moon because Elon says things. But like it would, the thing that made a race was there was a competition, and then it was like, oh, okay, the US is going to show you we can get there first, and then they would put all their resources in and they did it. But like other than that, like for all the other like they're just like, yeah, whatever, the moon's up there, that's fine. But then they were like, hey, Russia's trying to get there first. They're like, oh, say less, we're going to get to the moon first. Yeah. Like it's one of those things, and it's just like all these other the innovations and stuff like that. Like when so look at all this AI stuff out right now. So OpenAI, ChatGPT comes out. I didn't hear anything about AI. I've heard of things about other stuff, but like as far as the large language models that they're talking, the LLMs now, you didn't hear anything about that. Then ChatGPT comes out, it just starts going crazy. This was like November of.
Because now it's real. You can see it work. Yeah, you can use it, and like, whoa, Google, what are you doing?
Yeah, exactly. Yeah, it took all that for Google, Apple, like all these other companies. It took that thing where now these other companies, these big boys, they feel threatened and they're like, okay, hang on, now let's tackle this. And then you're going to start to see like all the evolution and innovation and all kinds of stuff with this. And it's the same thing. It always happens like that. So I 100% agree with that. I just thought that space race thing was pretty cool because that's literally what the US did. The US was like, yeah, we're not worried about the moon. Then they were like, hey, Russia's talking about the moon. They're like, oh, now we're worried about the moon. Yeah,
exactly. Competition. That kind of competition is incredible. Like, danger, all those things, they make us better, right? Yeah. Learning to deal with problems, right?
Yeah. I like that. Okay, so now I want to know. So with your combination of a billion shares, how many shares of SCHD do you have?
1,556 right now.
No fractionals?
1,556. What's that?
Can you have any fractionals?
Yeah, I have like 0.117. Yeah,
this is like pi for you. You need to know all the decibels behind it.
1,556.117.
There you go. I like that. That's your pi. Is you need to know all the numbers behind your SCHD. That's pretty good. So with your combination of all your 1.5 billion shares of SCHD and your individual stocks, so let's just say for the rest of 2024, where here we are in the beginning of May. Rest of 2024, what are your goals with your portfolio? And then going forward, let's just say 10 years, 20 years, what's your big goal with your portfolio?
All right. Well, so like I said, I like to set audacious goals, ridiculous goals, things that seem ridiculous, like going to the moon, because it drives you to hit them. Like you don't think you can do it. That's why you set that crazy goal. Like you with weightlifting, right? Like I played football and I'm small for a football player. And I got to university and my coach said, you're 150 something pounds. You're the smallest guy on the team. But by the end of this career here, you're going to bench over 300 pounds. And I said, you're crazy. And I didn't believe him. And guess what? I didn't do it because I didn't believe him. Yeah. After college, I started working out even harder and I did it. And I was like, he was right. I could have done it, but I didn't believe.
Yep.
I set the crazy goal after. I'm like, I'm going to do this. And I did it. SCHD. People always ask me, my first goal, like when I first got on Twitter, I was like, I'm going for 1,000 shares. I just pulled that number out of the air. Like, I was like, that sounds crazy. That sounds like something I could never do. And I said, I'm going to do it by, I think it was 2025. I was going to do it. And I'm like, it's crazy. 1,000, big number, big round number, boom. And I hit it in like 6 months or something like that. And now, like we just said, I'm up over 1,500. So with running, I run and I was like, what's a crazy goal? I used to live in Canada. I live in Florida. It's 1,500 miles back to my house from where I live now. In a year, I want to run that. I want to run back to Canada in the next year. So now I do that every year. I run back to Canada every year when I add up all the miles I run. Stuff like that, right?
That's wild.
And so, right? I'm literally childhood friends with my childhood hero from a movie, my favorite movie when I was a little kid. Because I set the goal. I said, I'm going to find this guy, and now I'm friends with him. Like, when they tell you you can do anything you set your mind to, it is 100% true. I never believed it until these things started happening. It's insane, man. It's insane what you do when you start committing to something and go for the moon. So, yeah. So basically portfolio goals, I try to set them crazy, like set them high. I don't even want to say how high my goal is for portfolio because it's for me. It's like ridiculous, and somebody will be like, "What?" And when you put out crazy stuff like that, people will criticize you too. But that's okay. Doesn't matter. But we're talking. I want my portfolio to be millions and millions, not just a million. Not like I want, right? And how I do that is by putting my head down and sticking to the plan of investing every day, of like stuff you do, like putting a little bit in the market every day, you know, and just letting it ride, man. And also working harder in life to make more money, and investing in yourself to get better and get smarter, all that kind of stuff. So I set these crazy goals and then put my head down and just go for it, right? Just keep going every day. Do the things every day that are going to get you there in the long run. And it tends to work.
So I'm assuming for your long-term goal, when you said you want to have millions and millions, I share this same sentiment. So do you plan to retire off of the portfolio? Do you just have it like, do you want to, I'm assuming if you want millions and millions, like the goal is that dividend income can be your income, right? Like I know some people that have the goal of their dividend portfolio being supplemental income, or their dividend portfolio paying for their vacation every year. But it sounds like you have the goal of you want to be able to retire one day, preferably, sooner rather than later kind of thing. Unless you really like what you're doing at your job, and then you want to live off of this portfolio. Is that right?
Yeah. And I'm not, I'm not like, oh, I need to retire by 55, like whatever. I'm almost 50 now. Right. So I'm having a good time in life. Like I don't need to stop. If I'm comfortable, I can. If not, let's keep going. Right. And um, I just want to enjoy it while I'm doing it. But sorry, what was the question? It was
just like the overall goals of the portfolio. As far, I mean, you basically answered it though. It's like, because I know some people, like, it's just the goals of their dividend, and I think that's another very important thing to outline when you start.
I do want to live off. Yeah, I want to live off the money from, like, mostly the dividend income, so it can continue to grow, and and I can pass it down to my kids, and they can pass it down to theirs. I would love to have this nest egg that continues to grow, with the dividend income growing all the time, not being, not dealing with the ups and downs of the market. Because if you're picking good stocks and good ETFs, that dividend income should always be growing, even if it slows down, speeds up, slows down. It's way more consistent than the market that's up 20, down 20, up 10, down 30, up 50, down 10. Your dividend income, if you've picked right, is going to just steadily continue to grow. And if I can always have that in my family generationally, there's always going to be something to fall back on, right? Tough times, it'll always be there, right? I don't want people to depend on that, because I don't want them to think that they don't ever have to work or learn and invest in themselves. But I want it to be there, so if things bad do happen, the world changes, it's hard to get jobs, they'll have that there. So yeah, not just for me, but like my plan is to live off it and then pass it down so the next can live off it, and just continue it. Keep it going.
I've talked about that a couple times before, and I'm curious your thoughts. Like, do you think that is how, like, I think that family, like bloodlines, generations, whatever you want to call it, I think they reset. And I mean, if you've heard the other interview, my idea behind that is just like, say when you were brought up, you didn't have a lot, right? Like, say a lot of people have, like, especially like where we are now, a lot of people's parents have come from some other country or something like that. You're brought up, they don't have a lot. They work real hard to give you something better. You always want to give your kids something better. But I feel like eventually that leads to this little event that happens where, like, the person, like, generations later will get more and more entitled. They end up getting lazy. They don't have a work ethic. And then it just resets from there. Because then eventually there's going to be that kid where they have nothing, and then they have to work really hard to make sure their kids have a better life than they did. What are your thoughts on that?
I'm terrified of that, because I came from a decent background, like middle class, right? But we had to work for everything, and we learned. I saw my parents, we were good. We never, we were never poor or wanted for anything, but we still worked hard for it, and saved money, and like we couldn't just buy anything we want, like, so I understand the value of money. But now we're doing well, and I don't know if my kids are going to have that same. Definitely, the big thing is it's different because it's not like oh, we can't buy that because we can't afford it. It's like, we can afford it, but no, you don't need
Yeah,
that.
we can't buy that because I don't want it in the house.
It's like, nah, you can't have that. We don't have money for that. Like,
Yeah.
forget it.
Yeah.
No chance, right? So you start to learn, well, if I want stuff, I got to make money. So I'm trying to teach my kids that too. Like, you know, like, we're doing okay, but doesn't mean it's all yours too. Like, you know, you gotta, it's hard. You want them to be happy. You want to give them stuff. You want to let them do stuff that maybe you weren't able to do. You got to balance it. But at the same time, you don't want them to grow up spoiled and just thinking they can have anything they want, right? It's a challenge that you face when you start doing better than the last generation. And then, like you said, it gets worse and worse, right? So like, if you start doing well and then it carries on and carries on, yeah, you're going to have a time where somebody's just not going to learn that lesson and it's going to all fall apart. So, but hey, that's cycles. That's the way the market works. That's the way life works. So we just got to do our best. So hopefully I can teach them something about caring about them.
I mean, at the end of the day, the ripple that you create only goes so far. It's not like the lily pad; it doesn't cover the whole pond. Like, you're not going to cover your family bloodline for 100 generations. That'd be great if it did, but like, at the end of the day, it's just like, okay, my goal is to at least have things the way I would want them done while I'm still here. After that, like, I don't know what's going on. Like, if they screw it up at that point, like, I did my job kind of thing.
Yeah.
But
and hopefully we can teach them the lessons that we learned while we're doing this. Like, oh, why do we have this big portfolio? Why are we able to pass this down? Like, how did we do that?
Yep.
And how do you keep that? You know, how do you, once you're wealthy, like, how do you stay wealthy, right? Like, so talk about those things. So
yeah, I like that. I mean,
it's harder. You got to do it yourself to learn it. You really do.
Yeah.
You can't learn anything until you've done it yourself.
I can see value in like people coming up with like a family like, you know, people are starting to do that with like the, whatever it is, 23andMe and like the stuff like that, the ancestry.com where they're like finding their bloodline and stuff. But like, that just tells you like who you're related to. I think it would be cool to have like some kind of, you might not write it in a book, cause I don't know if books will be like as relevant 50 years from now, but like put it in the cloud, wherever you're putting information, but like have something that your family can constantly reference that tells them about like your finances, how you come up, the goal of your finances. Like, if this works right, nobody in our family should ever have to need for anything. Like, they should, like, everything needs wise should be taken care of forever if you guys follow these steps, these blueprints and stuff. Like, if YouTube's a thing.
I've thought about putting together like something like, here's the money and you can't have it unless you're doing this, this, and this, and like, you know, like all these stipulations to it. Like, I always think of this movie, this 80s movie is called Brewster's Millions. This guy got a bunch of money, but he could like, you could take the million now, or you could get 100 million if you follow all these steps. And he's like, I want you to blow through all this money. It had all these stipulations. Like, you couldn't own anything. You couldn't waste it all here. You can't spend it all on one thing. You can't just give it away. Like, there's limits on everything. You only give. And he had to blow through, I can't remember what the number was, like $10 million. And if he was able to do this within a certain amount of time, he'd get $100 million. And it's like, it's really cool. Wow. It's with Richard Pryor.
Yeah,
it's a fun movie, man.
I
love the idea of just like rules for it.
Yeah, I mean that's like the rules for it, like the education behind, and like that's what the conversations are about. But I just mean for like future generations, like even something that your kids, like when you're gone, or your kids can look at, where they're like, oh, okay, like this was a lesson that was really cool. And like, I'm hoping to do that with the YouTube thing, if YouTube's still a thing 30 years from now, where my kid can watch it and he can see like one of the video, and like, it'll be cool for me to go back and watch it. Like, man, I really thought I knew what I was talking about right there, but I didn't know anything. Like, you kind of know, the more you learn, the more you know you don't know, kind of thing. So,
every time I think back to something I taled about a year ago, I was just like, oh, I was so dumb.
The cool thing about that is,
I look back now and be like, oh.
Yeah. I mean, that's the cool thing though, is like, that shows the signs of you growing. Because if you can look back on something and say, man, I thought I had it figured out, but this is clearly wrong. Like that, now you know enough to know that was wrong, which clearly shows you're further than you were, because at the time you thought that was the answer to everything. So I look forward to stuff like that. Obviously, I don't like proving that I was an idiot at one point, but I mean, we all were, or some of us currently still are. But I mean, that's, just growth, and I like that. So okay, next one for you. So. Biggest buying brag, biggest selling regret. Do you have any stories for either one or both?
Oh yeah, I got plenty of both in my time doing this. Like, let's start with the bad. So regrets. I've heard you talk about NVIDIA.
Yep.
I had 32 shares of NVIDIA with a cost average of $132.
Wow.
And I sold them at some point.
Yeah.
Those shares are up. Those shares at one point were up. What was it? Oh my God. I mean, it was almost $800 at some point from 132.
Okay.
I want to say they were up
It's
800%.
It's bad that you sold, but one, what did you do with the money? And two, did you sell it for a loss? That's the worst part.
I didn't sell it for a loss, but I certainly did not get anywhere near,
Yeah.
what where it is. But again, it was something, I bought was on someone else's conviction.
Yep.
And when things started going down, and then I was listening to like value people. So I'm listening to growth people and I buy it. I listen to value people and they're like, this company's worth nothing. It's all hype. And then I never figured it out for myself. And I should have learned because I had already been through a cycle of NVIDIA and had already done great with it, buying on dips when the cycle was down. I had already done that. And I forgot what I had already learned myself because I panicked when things were dropping. I'm like, oh my gosh, I used to be up 40% and now I'm only up 20. I don't want to lose it. And so I sold, and then I'm like, I'll get back into it. And it just took off and I never ended up getting back into it. So lesson learned, right? And yeah, and I put that money into good, solid companies, dividend stocks. It's doing fine, but nowhere near, of course.
Yeah.
Like, look, I still have half a share, something like that. It would right now it'd be up almost 600%. So, and that it was higher. It was, I think, almost at the highest point, like 700 or 800%.
That's
and I didn't have just like $1,000 in it. I had what I say, 32 shares.
Yeah.
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 It's a good chunk. It's a good chunk. And then there's been some others. The regrets was just, it all has to do with just buying on somebody else's conviction, basically. And then selling, like I've had a few other good, like AMD I did similar with, and other chip things. Again, I don't know the sector that well. You know what I invest in now for chips? I invest in the ETF, SMH. And it holds all the biggest chip stocks. So as long as that trend is going well, which it should for years, up and down, yes, it's like NVIDIA is like 20% of that right now because it's so big. But if NVIDIA falls, someone else might catch up, right? So it kind of it'll always do fairly well and ride that industry. There's other ones like McKesson is a healthcare stock, and I'm up. I have a few shares left, but I'm like up over 100% in it. But I sold along the way because, again, I didn't really understand what it was. So like, hey, I'm up 50%. Let me sell a little bit. I'm up 70%. Let me sell a little more. Now I'm up over 100. Like it just kept going, and I only have a few shares left, right? So it's like I should have been learning, like, why is this stock up so much? Like, what aspects, what factors does this stock have that I can monitor and use on other stocks? And that's what I'm getting into now is like, okay, let's figure out why these things are working. And if they're still working, stick with it, right? Don't have to sell, or don't sell at all. Sell little if you want to capture some of those gains, but hold on too, right? But again, I moved a lot of that money into ETFs. So I have too many stocks, and I'm trying to consolidate them into ETFs and stocks that I really love. So as far as bragging goes, this is one that's like just really cool to look at. It's just when I sold my house and moved to the US, right before I left, I topped up my Canadian retirement account. So in Canada, it's really cool. You like bank years of money. So it's not like here where your 401k has a limit, like $2,200, $22,000 a year. Mm-hmm. It's like if you didn't use your whatever it was that year, you bank it and you still have it. So I topped my wife's and mine, like, or at least one of ours to the top as much as I could. And I just put it all like 90% into the S&P. So that was 2017. So that's up over 100%. So like that is just a solid chunk of cash that's doubled in 7 years, right? So, and I've learned so much from that. Like the simplest decision I made, And I had people telling me, like, the people at the places where I invested it were like, are you sure you want to do that? You want to put it all into one thing? Shouldn't you do this and that? I'm like, it's more than one thing. It's the S&P, but
Yeah,
I
it's
feel pretty good about this.
505 or 503 things actually.
Yeah, exactly. But I feel pretty good about this. Like, I've looked a lot into it. I've heard Warren Buffett talk about how if he were to die and his family, he would tell his family to invest in RSP. These books I read and all this stuff, expense fees are not there, all this stuff. And I'm like, I'm doing it. And I still took a little bit and listened to those people and put it into like some more balanced things. I literally have it on paper. I can look back at that account. I barely ever look at it, but I can see that the S&P is up 100%. The balance thing I did is up 14% in the same time. So it's like, wow, look what happens with, simple investing. And then there's like other brags are like, Meta, when it was dropping, like I bought Meta really early on because I understand it. And when it dropped down, I still understood. I still saw they were still bringing in tons of cash. They were spending a lot of money too, but if they stop spending, that cash is just going to pile up. Mm-hmm. And I know how good they are at targeting advertisers. I know that money from billboards and from TVs and all that stuff, it's all going online. Who's the best at advertising? It's Meta, it's Google. I invested in those companies because I understood it. I worked in that industry. And so whenever they go down, I buy every single time. When Meta went down from 300 to 89, I was buying at 89. So all these things I talk about, I've done it. I've had the conviction and I've held on. And again, now Meta's up 100%. Google, I buy it every time there's bad news about Google. They have so much data. They are so good. Don't worry about it. And I buy every time Google dips. And it's up. It's not up as much because I bought it more recently, but it's up like 30%. Costco, I just bought it back in the day. It's up over 100%. I bought Costco in 2019, maybe 2020. It's up 100%. Microsoft, same thing. Every time it's down, I buy. It's up almost 100%. So yeah, even just my cost average on SCHD, because I'm buying shares all the time, but I load more in when the price goes down. So I kind of like tier it. If it's down a little bit, I buy like one share. I'll buy like one share like all the time. I'll buy more when it's down a little bit, more when it's down a little bit. Mm-hmm. I buy more on bigger. The bigger the pullback, the more I put in. So as I've accumulated all these shares, I've kept my cost average at $70 a share, So I'm, it's only up, what, 10%, 9% from that 70, but it could be a lot higher if I was just blindly accumulating all the time. Right?
Yeah.
And again, I can do that because I can be patient with it because I have so much. And because I have so much in the S&P, I'm investing all the time. So I feel I can be patient with some of the other stocks, right?
Yeah, I mean, so the thing that's wild about that is just like so I'm curious how you handle, because you've been investing for so long, how do you handle the mentality behind your cost basis? So like if you see do you look at it like I look at it, where it's just like, I know regardless of what, let's say Costco is one of my best performing stocks. When I look at Costco, my cost basis on Costco is like 530 or something. It's well over seven. It's like 720 or something right now. So like anytime I buy Costco, I know it's increasing my cost basis. But like if I were going to sit there and try to hold my breath to wait to Costco to get to my cost basis or lower, I would just never own Costco again. Like it's one of the, so like, how do you handle that? Where it's just like the end goal is to own more shares of Costco than you own today. So do you, irregardless of your cost basis, or how do you do that?
Well, I admire what you do, like, cause I struggle with that. I struggle with when I bought something so many years ago, well, so many, but like 4 years ago, it's hard to add to it. Like I can't add to my Costco right now. Like kudos to you for doing it. I can't do it. It hurts too much to add to it, right? But to me, you don't have to swing at every pitch. I'm fine with just leaving that there. If it drops big, I'll buy more because there's other stuff I can invest in the meanwhile. And I'm investing in the S&P no matter what. I'm always looking. So I basically have like a list of my watch list, and anytime they have pullbacks, that's when I invest, because I know I'm investing all the time in the market anyway. So I'm not missing out. and I'm trying to get the best of both worlds. I'm trying to have my cake and eat it too.
Yeah.
Why have cake and eat it, right? So, but I do admire you for doing that, and you've got to get started. Like you said, if you were waiting, Costco you would never own, and now you've done really well with it. Like, you know what I mean? Like I was like $500. I can't buy $500. My cost average on Costco is $339.
Yeah.
$340, let's say, right? So $500 to me, I was like, whoa, that's way too much. I remember when it dipped to 400 a couple of years ago, and I was still waiting, and I didn't buy more, right?
Yeah.
Like I should have, and I was about to, and I didn't do it.
Yeah.
So stupid.
Yeah,
so,
at the end of the day, like again, with my idea with the video I want to do with like the psychology behind it, it's just like, if would you rather own, if the math's wrong on this, whatever, but like, would you rather own 10 shares of Costco at $300 and say it goes to $1,000 a share, or would you rather own 1,000 shares of Costco, it goes to $1,000 a share, but you have a $600 cost basis? Like that, to me, like that's the difference. Is like, my goal is to own more and more shares of this company. They're not gonna. I mean, do what?
I'm just gonna say you're a lot, and you're 20 years younger than me, right? So you can handle the fluctuations a lot better than I will.
Yeah.
I'm more at this point starting to get interested in protecting what I have. Is important as growing it. You've got such a long horizon. You can handle that. So in your situation, absolutely keep doing what you're doing.
Yeah, that makes a lot of sense too. I don't know why
I can't risk as much as you could a big fall, right?
Yeah.
So there's that too, right?
Yeah. I don't know why I wasn't thinking of that, but like, just like in general, that for anybody that's watching that might be, in my boat or your boat, like that's a good way to like look at it from both sides of the coin, is like, as you, and anybody that's at work and you have your little target date funds in your 401k or whatever, that's exactly what they do. As you get closer to that target date, they start shifting in preservation more than the creation of wealth. It's more like, hey, your target date is, whatever, it's 20. So say 2030, that's going to be a lot more in bonds and treasuries and stuff like that than it is going to be in stocks. And if your target retirement date's in 2090, they're probably going to have you almost exclusively in stocks, a lot of tech, like stuff like that. So, it is about understanding the risk tolerance and the point that you are in your journey. But, as far as like anybody that might be good.
I was just going to tell you, like, the one thing I actually do as far as this, like how do I decide when to add to something that's up, is I talk about pullbacks a lot, but what is that? Like, how do you define a pullback, right? Mm-hmm. So I've made definitions for it, and I keep a spreadsheet of this with all my favorite stocks, all my favorite ETFs, and I have it set up where it's listed the price. What's a 5% off the 52-week high? What's 8%? What's 10%? What's 15? What's 20? And then I have it highlight when it's under every level, right? So then I start looking at it, and I can sort it by like what's down the most, and I have it sorted out. And that's kind of where I allocate like my daily money, is like, okay, well, these are my favorite ETFs. What's closest to 5, 10, or 8? Actually, I look at 8, 5, 8, 10, 15. What's closest or what's under? And that's where I allocate more money to. And I do that with individual stocks too. So when I see stocks hitting these levels, I'm like, okay, it's a good time to put something in, right? And it, you know what, it really works well. And like, for instance, I didn't follow this with Apple. So Apple it was under my 15% pullback from 52-week high. And I was like, I'm going to wait. And then what happened? They just put out the earnings the other day. Boom, they're right back up again. But they hit the 15. And for an individual stock, if they hit 15 is usually a really good time. Like, of these solid companies, it's a great time. And if an ETF, the S&P or SCHD or DGRO, one of the Qs, if one of these hits good levels, like 8% or lower, dude, invest. Like, you don't get those pullbacks that often on really like broad market ETFs. Put the money in, you won't be disappointed. It works out. Like, I literally looked at the stats. I can't remember the exact number, but there's only like there's a 10% pullback like once a year. That's it, right? 10% or greater. That's it. So if you're getting that, if you're at 8, go for it. And they also say once you get to 5, you often go to 8. So when I get to 5, I might hold off and wait till late. So I don't know. I play it right.
You could just do like so one, you learned your lesson probably again. That's probably not the first time that happened where it hit the number and you're like, well, I'm gonna wait for a little bit more. But I do feel like the market's like more, and I have a video idea on this too, but I feel like the market is more volatile where you can just have a random day where you're up 4%, down 4%, like all the time. And I feel like that's gonna keep going and get worse over time because there's so many like less restrictions. There's not it doesn't cost to trade. People can trade on their phones. I've been saying for years on this channel, I think we're going to 24-hour trading. I just saw an article in the news, or it's like somebody shared on social media talking about the markets thinking about going to 24-hour trading. I'm like, the test market was crypto. They see that there are people doing crypto 24 hours a day. Doesn't matter if it's a holiday or whatever. And honestly, I would argue that crypto picks up when the stock market closes. Like there's more activity on crypto because people are just addicted to this stuff and they just want to buy and sell stuff.
They're like, what can I do now?
Yeah, like, well, it's 3 o'clock. What am I supposed to do with myself? So like they go to crypto and they're like, oh, I want to trade some doggy coins or whatever stuff they talk about. So all kinds of stuff like that. So one, you learned your lesson with that dip thing. And another thing you could do, and you might already have this, is like you could have a certain amount of money that you want to allocate towards these companies. And then as you hit 5% off, it's 20% of the capital that you want to put towards. And as you hit 8% off, it's 33% of the additional capital. And as you get 8% off, as you keep going up, or as it gets to 10%, it's like, hey, 75% of my remaining thing, it's there. And then, if you get to, 12% off or 15%, then it's like whatever I have left, it goes into this thing. So like you could just do things like that. And that way you take anything you can do that is in a spreadsheet. This is like from my own experience. I have a spreadsheet that shows me how much I'm adding to each stock per day. That's it. That's all it tells me. It doesn't matter if we're up. It doesn't matter if we're down. It doesn't matter what's going on. And it takes literally there's no emotion. There's no guesswork. There's no, hey, Troy, what do you think about this being down? Like, I don't care. Like literally it says, hey, Monday, you're adding $4.62 to Apple. Guess what I'm doing on Monday? I'm adding $4.62 to Apple regardless. So like,
I love it.
And you could do that with your thing where like, hey, just like you trusted yourself enough to make this spreadsheet. Trust yourself enough to like at least try it. Like you're not going to hurt yourself with it.
Trust the process. I always say set up a good process and trust it, man.
Yeah. I mean,
and that's why I like SCHD too, because it has a process.
Yep.
It's worked over the years and there's no emotion to it. It just does what it does and it works out in the long run.
Yeah.
And we have emotion. It doesn't. Like people always say, oh, why did they take this out and sell this? And because it has a process, like it's sticking to it. It's not because somebody said, I don't like this stock anymore, or the trends are changing. No, it didn't meet the filters, the metrics it's looking for. It's out. That's it.
Yeah. I mean, that's literally like so on Facebook, when I was telling you about that group, when I came up with my criteria, which quickly outperformed the S&P 500 over the past 10 years, a 3, 5, 10-year dividend growth rate above 10%, and at least 5 years dividend streak. That's my criteria. When I was figuring that criteria, I was like, hey, I'm noticing that companies typically perform well and have good metrics that meet these numbers. These are numbers I understand. I can easily find them. Those are my numbers. I posted it on Facebook and I was like, hey, somebody find me a stock that sucks with these numbers. It has to meet these numbers. Some people were coming back and they were like, I know you said you want a 10% dividend growth rate. This one's got a 9% and it's actually not looking really good. I'm like, well, that's not how filters work. That's the thing. Is like, I don't say, hey, 10% or something close to it. Like, it's like, hey, if I filter for 10%, anything that's not 10% disappears. And that, like, again, taking the emotion, like I can say, for me, I like Starbucks is one of my holdings. ExxonMobil is one of my holdings. Those are two of my suspended holdings because they're not meeting my criteria. I don't hate them as stocks. They're just not doing what I'm expecting them to do. So they're on timeout until they behave themselves. So, and it's one of those things. And like, I kind of battle with that too. Cause like, if I bring the emotions into it, I'm like, well, if they're not meeting my criteria, wouldn't this be a great time to add to them? Because now they're getting beat up. Like Starbucks just went down a lot. That was 16% off in a day. Like I could have done that. I could have lowered my cost basis, but I was like, I'm not. So another thing, when you were talking about criteria and stuff, you trusting the process, all these things, you don't know whether a process does or doesn't work, or a criteria does or doesn't work until you give it a shot. You have to see if it works. You can't jump in and make all these amendments and changes and stuff like that, because then you'll never know if you were onto something or if you weren't. You have to give it a chance.
Yep. Yeah.
So,
good point.
okay. So anyway, next thing. So I want to know if there's any dividend related milestones or achievements that you've recently achieved or that you're getting close to achieving. And then more importantly is like, what role do those play in keeping you motivated? Because investing is such a long game. You need like those little small victories here and there just to like, you set big goals, right? So you can't have, the big goal and not have any milestones, on the way there.
Yeah. Well, it's interesting for me, I didn't track it in the beginning. I definitely track it now. But in the beginning, when the dividends coming in were small, and this probably is different than everybody else I see on Twitter. Like, there's nothing wrong with it. I think it's great. But like people are already up, well, I got $10 here, I got $20 here, I'm up to 100. Awesome. But I wasn't paying attention at all. I had my head down. I was just putting money in, and I wasn't paying attention to that until I look back at like tax time, and I do my own taxes, and I was looking at dividend income there, and I'm like, oh, look at that. I keep track of this, but I look back. I don't look at it every day.
Yeah.
So I look at like, okay, 2020, I made so in the beginning. So 2018, I made $175 in dividends that year. 2019, I was up 140% to 420. 2020, $1,000 now, up like over the last year, 146% over the last year. Then 2021, this is when I started investing in dividend stock. Now I'm making $6,000 a year, over $6,000. I was up 500% from the year before. 2022, now I'm putting in a lot more money. I'm putting in. So like, this isn't just growth of the dividend.
Yeah.
Right? It's both. I'm adding. So now we're up to 11,500 in 2022 per year. And then last year, over 14,000. So I went from $175 to over 14,000 now. And this year I'm on track, and this will go up a lot because I'm still adding all the time. I'm over 16. Right now I'm over $1,600. Sorry, $16,000 a year.
That's your projection for this year, right?
For this year, yeah. And it'll definitely just keep adding because I'm buying every day.
Yeah.
So yeah, it's interesting because I look at it in chunks. I don't look at it every day, but I find when you look over longer periods, that's when you really see that it's adding up, because it can get frustrating when you're like, oh, I put all this time in or whatever, I invested all this money, I made $420. Like, okay, that's nice, but
yeah,
what is it, right? But then that in 4 years, $420 is now $16,000, right? So it's like, you got to look back over long periods. And then day to day, I stick to the plan, right? Just invest all the time because I know in the long run what those daily activities do. So yeah, that's the way I look at it.
Yeah, I've said this a bunch of times on the channel, especially in my monthly recaps. The thing that I always recommend for anybody that is just starting is I think it's essential to track it because it is very motivating. Like, because if you're buying dividend stocks go up and down just like regular stocks do. So if you're buying dividend stocks and you see, if you're not tracking anything, you start to track the price, and the price is where the emotion comes in. So like, you're not worried as a dividend investor, the price, especially if your journey is 20, 30, 40 years long, I don't care what your price is today. It does not matter. It literally won't matter. So like, I always say track your dividends, and the thing that you want to focus on in the beginning isn't the dollar amount, because to your point, it is small. So focus on your percentages. When your amounts are so small, like if you can go from January of this year to January of next year and you're up 250% or 1,000% or something, your percentages are going to be wild, like unbelievable wild. As your percentages start to creep down, and like yours are probably creeping down, like this April to last April, it might only be 25% or something smaller, which is still really good, but it's not 1,000 anymore. But now you can look from last April to this April, and instead of making, forget my numbers, whatever, they're probably wrong, but like instead of making $400 this month, you made $600. And then you're just like, oh, okay, like $600 in a month, like that's a car payment or that's groceries or whatever.
That's an excellent way. Yeah, that's an excellent way to say it. Look at the percentages in the beginning, and then later on, you can look more at focus on the dollars. Because I'm looking at it now. I have it right here in front of me. And and early on, it was over 100% every year, then 500% one year, and now it's come down. Then it was 80, then 25.
Yeah,
and 10,
it doesn't mean you're getting worse. It's the same thing with with Apple and like its market cap and stuff. Like Apple doesn't regularly gain 50% in a year. Like it's too big of a company. When you're small companies, they can gain 50% in a year because they're small. Like they're literally, Apple threw away more money than that company's made in the last decade. like it's just one of those things. So exactly with your
their buyback, you see their buyback.
Yeah, 110. But Apple has the record for the 5 largest buybacks in history. So it's not news to them.
They can buy whole giant companies. Like they can buy Chipotle. They can buy the whole thing.
Yeah, and still have money left over. That's wild. Yeah, it's insane. So
buy back extra money.
Yeah, that's the but yeah, that's one of my hacks. Again, I always try to find the way to remove the emotions out of it, and how to keep motivated and stuff like that. Especially in a game you're going to play for 40 years, you need to find a new flame kind of thing. So yeah, percentages in the beginning, as those drop, you can switch your focus, because now, like I said, with your portfolio, if you're going to make 16,000 this year, you're going to have, that's well over 1,000 a month. Unless you have really good months or really bad months. So you went from making, where say 2 years ago you were making $200 in April, now you're making $1,400 in April. You're like, oh, okay, like that.
And I really look at that, like you said, it's $1,300 a month in just dividends, and I don't drip it automatically. I reinvest that back into things that I like.
Mm-hmm.
That's getting reinvested every month. So I look at that and say, I have $60 to spend every day on the market. It works out to about that, right? $60 a day. So every day I'm investing at minimum $60 into a good ETF at minimum. Then I'm looking for other stocks, but I'm every day $60 at least. And then I sell covered calls and I make another probably $40 to $50 a day. And I put that into dividend and other ETFs as well. So every day I'm investing at least $100 every single day on top of the retirement stuff that's just happening automatically.
Yep. And that's what we were talking about a while ago, is just the idea that you basically now have 3 people contributing to your portfolio. You have your wife, and then you have this dividend thing that you created.
And then I have the covered calls as well. Covered calls and selling puts and stuff. Selling covered calls.
Yeah, that's super cool. I mean, that's where we're all trying to be. So this is a perfect question for you. And I am super excited I say this all the time, but I'm really excited for your answer too. How and when will you know when enough is enough?
Oh man, like I said, I just got my head down and just enjoying it, man. I'm not never. It's you're never done. Why?
Yeah.
Why you got anytime you take your foot off the gas pedal, things go wrong. When you stop focusing and stop doing what got you where you're trying to go, things go wrong. You can't lax in certain things. And I just feel I'll know when I get there, right?
Yeah.
When I get there, I'm like, hey, we're good. But until then, I'm just going to keep pushing, right? And because I enjoy it, right? It's different if you hated life and you want different and you want to do something. You'll probably figure out that no matter where you go, you're still going to have the same issues. No matter how much money you have, probably still have the same issues. You got to find a way to enjoy what you're doing, or you're just never going to be happy. You got to enjoy the journey, man. You don't. It's most of the fun. Getting there. Sometimes you're there. You're like, what? This isn't as good as I thought.
Yeah.
I enjoyed more getting here than when you actually got there. So yeah, I'm just enjoying the journey.
Yeah. I mean, a lot, whether you're going to cry on your way to work in a Ford Focus or a Bentley, you're still crying on the way to work. So it doesn't matter too much. So
people say it all the time, that money doesn't make you happy and all these things don't make you happy. To a certain extent, it's true. It's because it could make you happy, but you need things to spend it on. You need, richness in your life to really enjoy it. So
yeah, I like that. Okay, so you've alluded to this before, and I want to know now. You have me intrigued, and all the billions of people that are going to watch this are also intrigued. What is your filters? What are your criteria that you're using to pick your individual stocks?
Yeah, so return on invested capital is a big one. I like it because it basically simply tells you how much money am I making on every dollar that I'm investing in my business. For every dollar, I'm making back 20 cents. I'm making back 50 cents. It encompasses almost everything. It just tells you how efficient that company is with the money they have. So it tells you about management. It tells you about debt. It tells you about all their assets. It's the one metric that I feel is the most all-encompassing. So I really like to see that, and I like to see it above the S&P's average, which is 14, 15%. So I like to go 18, 20, well above, right? but at least there with the average. And then I look at things like, are they diluting shares? So like, are they selling shares? Because that's kind of a hidden thing. Like, this is how they're using that as debt, right? They're selling their own shares and they're diluting your ownership. And that's just a sign, like, technically, there's nothing wrong with a young company doing it. It might be smart for them to do that, right? So, but it just shows to me that that company is not mature yet. There's going to be a lot of fluctuations because the stock price will go down when they dilute it. So if they're constantly doing that, all your gains can be lost overnight when they're doing that sort of thing. So you want to try to avoid companies that are doing that. And then, like you, I look for like dividend growth. The streaks are important, but they don't matter as the 30, 40, 50 years don't matter as much to me as like 5 years. And like just starting out is more important to me than, because you get a company like 3M, like I think of the tickers all the time, like WB, Walgreens. They were dividend kings and whatever, champions, all this stuff. But boom, overnight it's gone, right? The length of the strength matters, but at the same time, maybe they're due for a cut. There's other things you need to look at, right? It's not just the streak, but a streak is nice to have. But I do like to look at the 10-year dividend growth, the 1 year, the 3 year, compare, see how that's going. So that's something I always want to see growth at least, dividend growth that's at least beating inflation, at the very least, right? So like 4 or 5% over the last year. And then I like to see closer to double digits over 5 years. And then like, I really like Simply Safe Dividends, and they lay this out. It's a website. They lay it out really easy to see this. It's made with crayons. Like, it's so simply laid out. It's very nice, right? It makes these like really difficult metrics like really simple to see. It's all in graphs over like the last 10 years, and you can just see if like how's sales growth going. Like, is it going well? So I look at some of that, so like positive sales growing free cash flow, payout ratio. I want to see their debt is not spiraling out of control. Yeah, those are the main things. But really, number one, like I started with, return on invested capital, dividend growth. And honestly, the starting yield doesn't matter that much to me. I don't want to see it super high for the most part, unless there's a good reason for that. Like, unless they're just swimming in cash and they have nothing to do with it. But then you just got to realize all you're probably going to get out of that company is that dividend. But if it's 8%, and even if that company doesn't grow or grows at like 1%, well, you still have a 9% return, which is pretty solid. Yeah. So there's reasons for that, especially if you're older, right? That's not for everybody, but that could be what works for you. So again, not focused on the starting yield, more focused on the growth of that yield and the payout ratio and that sort of thing to make sure that they can afford to pay it.
Is there a level of the yield, both high and low end, that's like too much or too little for you? Like, would you entertain a stock that's got a 0.2% yield, or would you entertain a stock that's got a 12% yield?
Yeah, like I'm not concerned. I used to be, but I'm not concerned with that starting yield anymore at all. It can be point whatever. I like to see it, but I invest in companies that didn't have them, and guess what? Now they do. Yeah. Like, I've invested in Google and Meta for a while, and now they pay dividends, and there's a good chance they grow those dividends really well, right? So eventually good companies start paying dividends. So I'm not that concerned. And like, even Meta, look at Meta, they yield maybe 0.5. Yeah. But I think my yield on cost might be 1%, like a full percent, right? Visa, you look at the starting yield on Visa, what's that? You probably,
I think it's under 0.6.
Right. But my yield on cost for Visa, that's another one I've done well with. Visa, MasterCard, my yield on cost, 0.85, nothing amazing, but you see the difference though. Like, the starting yield right now is 0.6, but mine's 0.85. Yeah. Visa is, Visa is 0.77 right now, but mine is over 1. So the starting yield doesn't matter as much when you're able to grow it. And I've only held these stocks for 3-4 years, right? 3 years, maybe some. MasterCard, probably 3 years. So it's not as important as many people think, depending on where you're at with your journey and what type of investor you are. Yeah. Remember, like we talked about in the beginning, it's your situation really matters. So some people might need that, right? Some people are looking for something that's going to give them safe 3% every year, and then know they only need another 5, 6, 7% to, to keep up with the market sort of thing.
Yeah. I think the hard part is that people have a hard time classifying themselves. Like we talked about before we started recording, is people are 18 years old and they think that they're the ones that need the income. And I'm like, I mean, are you planning on retiring at 19 years old? Like in that case, then yes, you would need the income. But like you're robbing yourself to, it's one of those things like you were talking about before, like with the delayed gratification. Yeah, you can get your 18, 20, 30% yield on your portfolio today, but that's going to be, that's it. There's no light at the end of the tunnel. You're at the end of the tunnel. Like you're there. And if that's all you want in life is just a quick 18% on just the money you're going to have, and there's no compounding there, then by all means it's your money. Yeah. But like if you're 18 years old and you plan to work till say 68, you got 50 years of investing and compounding with these companies.
Do you think about
the ones I talk about in my top 5 series and stuff, man, like some of the best, because like typically I'm jaded towards the ones that perform the best, right? Like that's the ones I always just look towards. Like they always catch my eye. The one I just talked about this last Friday at the time of recording, Comfort Systems USA, $10,000 into $218,000. Just reinvesting dividends. The dividend yield's super low. You have ODFL, you have like Old Dominion Freight Line, you have all these kinds of stocks, your Visa, your MasterCard, your Pool Corp, stuff like that, where they're just multiplying your money year over year over year. Yeah, the yield's real low, but like you were talking about with yield on cost, it doesn't matter what your yield is today. If you need that investment to yield, 5, 6, 7% 40 years from now, you can get there because your dividend's growing at 20, 30, 15%, whatever it's growing at, and you're going to hold it for a long period of time. So that's what I agree. It's definitely not for everybody. Everybody needs to decide their own journey. It's just really looking in the mirror and being honest with yourself. Your journey isn't based off your age. It's based off of when you need the income. If you don't need the income today, and I don't know, you can talk about this if you want. People do this dividend, like obviously the dividend snowball is what everybody's going for, right? Your money makes you more money, stuff like that. People are doing this dividend avalanche method. I don't think it works. I've heard about it. I want to do a video on it. I need to figure out how to formulate my thoughts on it, but I don't think it works. Are you familiar with what that is?
We're talking about like a yield max or something that gives some crazy high dividend, and then investing the dividends into another growth ETF, or stock or whatever. Yeah, I'm like, just cut out the middleman. If you have the money to invest it, put it in the good thing first. Why go through someone else when the capital is going to deteriorate and you're getting some of your capital back? They're giving you your money back in the yield.
I see so many people do, and like to each their own. Like, so you have to go through it and figure it out. I guess going back to the emotions, the psychological part of it is that these companies are paying you so much money that you can use their money to buy you things. So technically you aren't, even if you lose money on whatever company you're buying with this dividend, you're technically not losing any money. That's the way they see it, because it's not their money they're investing, it's Yield Max's, but Yield Max is just giving you back your money to put it. It doesn't make sense to me, like as logically as I think about it, I'm like that. So not only are you delaying the purchase of the company that you're going to use the dividends to buy, which in most cases that company's now more expensive than it was, but you're also losing the original money that you're putting in the Yield Max stuff or whatever else you're putting it in. So you're putting in 100, getting 75, using 75 to buy something that used to get you 1 share. Now it's getting you 0.8 shares because now it costs more money than it used to.
Yeah. I mean, that stuff, like right away when it came out, I was just like, this is too good to be true to be getting 60, 70% dividend yield. So right away, I'm just like, I've just learned if it's too good to be true, it's probably not true. So just avoid it. So I've taken in information a little bit at a time, and nothing has changed my mind from that gut feeling I had about it. People say like sometimes your gut knows something before your mind does. Mm-hmm. Like you got to trust your instincts. Like this is just one of them for me. And I don't stick with that. I'll look into something and I can change my mind on something, but nothing's changed my mind yet. Maybe someday it will, but not yet.
Yeah.
And, probably not.
Going back to what we were talking about before with like the tracking of your dividends and stuff, that's where the slope gets slippery, because people try, like whether it's your patty, the number that's projected for the next 12 months, or whether it's your tracking spreadsheet, people get so obsessed with trying to make that number go up by any means necessary, that's where the yield traps come in.
You're absolutely right. That's why I don't look at it day to day, because I don't care if I was making $1,000 today and then the projected goes down to 950 the next. I'm just picking a number out of the sky.
Yeah.
But that doesn't matter to me. I want it over the year to be better. I don't care day to day, because I'll sell a higher yielding stock today to get a better, something that I feel is better. Just period. Better growth and everything. Better, has a lower starting yield. Like, I'm literally doing that right now. I'm selling some of these stocks that I've had that have a better yield. I'm doing it. Like, and I don't like seeing that padding number go down, but it's okay, because over the years, it's going to grow even more. Like, I look at that rule of 72 all the time. You know that one, right? Like, you divide your whatever yield you're getting, your interest, you divide that into 72. And like Visa, 16% dividend growth right now, I think over 1 year and 5 year. So every 4.5 years, your yield is going to double. So yeah, it's only paying under 1 now, but then you're getting 2, then you're getting 4, then you get 8. Boom. That's
like the best representation of that is looking at something like Broadcom. Like Broadcom's up to like what, $22.40 a share. And if you look at Broadcom like 6 years ago, their dividend was paying out like $12. Which is obviously still a lot. Like, I have several companies that are paying me like $1 a year per share or whatever. But like, you look at Broadcom and like, just go on Seeking Alpha and just look at like what Broadcom was paying per share per year, like 6-10 years ago. And now you look at it, you're like, now they're paying 22. Now, granted, the stock cost a lot, the yield's still low and stuff like that. But like, it's just one of those things where like some people focus so much, like they don't understand that those two numbers are connected. So like when I'm doing my top 5 series and I'm like, oh, this one's paying out $6 per share per year. They're like, oh, that's really good. That's really good. And then they're like, oh, it's got a 0.7 yield. I'm like, okay, that's the same as a 0.7 yield on a company that's a lot cheaper, that's paying out maybe $1 per share per year. Like, those numbers are, that's all connected relative to the stock price, what they're paying out and stuff like that. So thinking that those numbers are like, I know some people that literally chase that number. They look for the company that pays out the most per share per year. They don't, like, the yield doesn't matter. But that, like, they're doing it that way. And then the other people will do it the other way. Where like
you're right. I've had people ask me on Twitter, like, or X, like, well, why would you invest in this stock if it pays you like you said, like $1 when this one pays you $2? It's not,
even though the yield from the dollar one's actually more.
Right. Like, that's, like, someone literally compared like VU to SCHD, not on the basis of growth, like of capital gains or anything. It was like VU pays $4 per, whatever it is, $4 per share. SCHD only pays $2.65.
Yeah.
Why would you ever?
Yeah.
On that basis, I'm like, yeah, but it was $400 and whatever. Dollars.
It's a disconnect. Like, people don't think that those have any relation to each other, and like you don't, like, I don't think people
go the other way.
Yeah.
People go the other way with the stock price. Well, that thing's only $10, and that's $200. Why would I spend $200 when I can get some for $10? I'm like, oh.
Well, I feel like that was accentuated a lot with the crypto stuff. When like you had things like the difference between Bitcoin, Ethereum, and like, let's say a Dogecoin. Is like, I know the same people that I said that are turned off about investing, they were like, oh, I don't want to own, a 0.000146 shares of a Bitcoin when I can own 10 million shares of Shiba Inu. And I'm like, you have 10 million little turds instead of like one big thing of gold. Like, what does it matter? Like, why does that matter?
Absolutely. Yeah. And that's one of the things that people early on have to learn, right? Because it's counterintuitive to think that, well, this thing's cheaper because it's the dollar value, right? Like, that's everything we see in life is a dollar value. So yeah, it's all about how many shares are dividing that up. It's not,
I think the Broadcom is like the best illustration of what you were just talking about with like Visa's dividend and stuff. Like, I look back at that one. There's a bunch of stocks that, like, if I bought all the stocks I liked from my top 5 series, one, I would have too many holdings. And then 2, like, I'd be spread so thin with my money. Like, I don't have enough money in my portfolio to have like a substantial position in anything yet. I mean, I think I have 2 positions over $5,000, but other than that, man, like, it's not, I don't have a ton, but
great, man. You're only 28. That's awesome.
Yeah. It's, work in progress. Like I said, it's like the gym. Every day, just keep going in and see what happens. But, okay. So last question for you. We skipped some questions, but I think we already covered them like throughout the interview in general. So You're now 18 years old. Um, let's just say you don't have kids. I mean, you could be 18 with kids, I guess. But you're 18 years old. Everything else is the same. Everything's the same. Everything you know is the same. Stock price of everything is still the same. You can't cheat. You can't be like, well, I'd go back when Apple was, at $5. Can't do that. Everything's still the same price. What tips do you give yourself? What tips are for your younger self? What would you do different? What do you got for us?
Yeah, put it all into Apple, all of it.
Yeah, back when it was $2 a share.
If we go back.
Well, no. You don't do Apple. You do Nvidia.
Yeah, whatever.
Yeah, that's the one.
No, but seriously, in the beginning, I would set up a massive core as much as I can into good ETFs, like broad market ETFs. So the S&P 500, a dividend growth, like I'd pick a little dividend growth, SCHD, DGRO, something like that. Do a lot into the S&P, and then a little bit into like a higher growth, like tech kind of thing. So like I like SCHG, which focuses on like growth companies in general, not just tech. It focuses on all growth. So if tech is leading, it's got that. If industrial start leading, it would have that. Like it doesn't just, whereas the NASDAQ is kind of more growth, it's got some other things mixed in. Sorry, more tech, other things mixed in. If you focus on tech, you're getting only tech. Tech might not always be the leader. Might be, but we don't know, right? But it covers your bases either way. So again, something high growth, something broad market like the S&P, and something with a little dividend growth to it, and then maybe something with like international to it, right? So that could be 4 ETFs that cover that, and then you can twist the dials on how much you put into each based on kind of your risk level you're willing to take. And to make it easier, that when you're young, 18, you could put more skewed to the growth. Again, I put the majority in the S&P and then skew more to the growth, the SCHG or the QQQ, than I would to the SCHD when you're 18.
So right? let's say the percentages on that are 50% VOO. Let's just say 35% QQQ, 15% SCHD.
Yeah, something like that. Like, so keep the S&P kind of the base, the biggest part, and then flip your growth and your SCHD, your SCHG and SCHD. Just so whatever. So as you get older, you can start taking down from the growth and putting more into the dividend. Make sense?
Yeah. So I like that idea. I think the ETF base is like widely considered to be like, hey, if I had to start all over, that's what I would do. Do you have like, now keep in mind, typically 18-year-olds don't have a lot of money. It takes them a lot of time to get a lot of money. Do you have an idea on what you would recommend your younger self do, like as far as how high you would build that before you even think about branching into individual stocks? Like, is it 5,000, 10,000?
More like, what have I learned? Okay. What have I learned enough to start into building? So that could be months, it could be years, it could be never if you're not someone who wants to pay attention. So I mean, and you can even play with a company you really like and are ready to follow and ready to dig in. Like, take some time, like buy, Apple or something that you understand, Microsoft, something you deal with, or something in your job, something you have a little bit of an edge on, right? It's something you understand, something you go to every day and you see, this place is slowing down, or it's really busy, or, something you care about. So you could play with a little as you do that, or wait until you've learned more. So yeah, it's more about how much you've learned. And at the same time, like, just work hard on, when you're young, like you say, you don't have a lot of money a lot of times. So work on making more money. Like, how can I make more money? And really put your head down and work hard. Like, I worked my ass off when I was young. Like, after school, I worked from 7 a.m. to 7 p.m. every single day, and on the weekends. Like, my wife did the same thing. We worked our butts off. And at that time, we were just investing in our retirement accounts automatically. And then when we were ready to buy a house, only 5 years later from starting work, 6 years later from like starting kind of full-time work, we didn't even have to think about the down payment, because we took it out of our retirement. Canada, I don't know if you can do here or not, but you can take out of your retirement account for your first home, no penalty. So we were able to do that without even thinking about it. Down payment covered. because we were working around, and then we built our skills and we built our knowledge and our experience so you can make more and more money. Just when you're young, that time between like 20 and 35, 30, like just work your butt off, man. Like you can handle it. I used to work like that, party at night, no sleep, but I could handle it. So do it while you can when you're young, man. Yeah.
Yeah, the sacrifices, and like that's one of the things I'm going to cover with that video idea I have, is just like, what is the multiple? If you start at 0, if you start at 10, if you start at 20, like what is the multiple of like a simple quick number that I can figure out that says if you make $20 at a 20-year-old and you invest that at 8% over the next 40 years, like what's the multiple on that? Like it's not just $20 anymore. Now it's $20 times, let's say it's 20x.
Yeah, I've seen a study on this, and I think they use like 10%, let's say, but at 10 years old, the wealth multiplier is 240%, or something like that. So it's like, and it said like the monthly savings you'd have to put away to be a millionaire, to have $1 million at 65, if you start at 10, is $35 a month. Mm-hmm. That's it.
That's literally like the idea for the video I have. I already did all the research for it. I'm just trying to figure out like the best. Like I said, my idea is.
I'll send you the article I found.
Yeah.
And at 20, it goes up to 95. At 20, it's 95. This is the amount to have $1 million at 65. At 30, it's 340. At 40, it's 1,000. At 50, it's 3,000. At 60, it's 14,000. Yeah. Right. So. Yeah. The one I did has it's just like, it's a big Excel sheet. It has a 8%, 10%, 12% returns, because I just did 10% with a deviation of 2. And I figured it out from 0 to 6. It wouldn't let me do 65 because if your goal is to retire at 65, you can't invest anything to get there. But the goal was, again, to make $1 million. Obviously, we know that $1 million, when you're 65 today, like if you start at 0, 65 years from now, $1 million's not going to be $1 million, but still going to have the same number of commas. It just won't buy as much. But, so yeah, I did the same thing, and I'm trying to figure out a way to group the videos and make the videos, because I'm trying to go for the target audience and stuff like that. But yeah, I want to, like, if there can be something that is commonly known for either the parents, the teachers, the kids, or the kids just know this, like, hey, if you're 8 years, like there's a kid in my neighborhood, his business is cleaning out people's trash cans. So like they'll call him up. He gets his hose, he gets in there, he gets a little sponge and stuff, and he'll clean out all the little gross juice that's in the bottom of your trash can. And he just makes like $10 a trash can or something like that. And like, if you're like, okay, cool, he's 8 years old. What's the say he made $100 on a weekend. If he puts that in the market, 8%, what's the multiple? Like, what number can I give him and say, hey, just because you did this, it's not worth $10. It's not worth the weekend that you quote unquote lost, or instead of sleeping in, you went and made money. This is the multiple. You hit that multiple times whatever the number you're thinking about. And you can do this for your daughter too. That'll be really helpful, where you're like, hey, it's this number. Like, it's not about this $5 you're about to spend. It's this times this because of how old you are. That's what your number is. Yeah. I showed her this. That what I just said to you, I showed her this, and I'm going to keep reminding her that $10, that $35 today is going to be worth this much later, 230 times.
Yeah. Now what you do is at that point, especially when she gets to the point where she has her own money, is you're saying, okay, you're willing to buy this, these pair of jeans for $30. Like that's reasonable, right? She's like, yeah, that's reasonable. You're like, okay, now your wealth multiple on the same pair of jeans, because you don't need these. These aren't a need jeans. These are want jeans. The multiple on these, would you be willing to spend $780 on the same pair of jeans? And if she's like, no, that's too much, you're like, all right, well, that's what you're about to spend instead of investing that money in different.
That's what you're giving up. Love it. Yeah, it's awesome.
Yeah. So there you go. There's a little tip. Okay. Anyway, Craig, it's been a blast. We went almost 2 hours, so I told you this would be hard, but it's been a blast.
I knew when we started talking, like both of us can talk.
Yeah. Hey, it's been a blast. Like I said, I didn't want to ruin our conversation by watching your other interviews, but I appreciate you for taking time out of your weekend to speak with me. It was our first time meeting each other, and I feel like I got a good friend out of this. So I appreciate you taking time to speak with me. If you have anywhere where people can find you, anything you write, any content you produce, let people know where they can find you. And like I said, all this stuff will be in the description down below the video. So make sure you go give SCHD STAN, aka Craig, a follow wherever he gives us the information.
Yeah, so lately I've created this character on X, Twitter, called SCHD STAN, and it's at SCHD ETF is the handle. And that's where I post daily updates on SCHD. You can follow my SCHD portfolio. And I just started an account on Blossom as well. I learned about Blossom from Ryan Williams, watching him. And I just started that there. So I've got more of my portfolio there as well, not just the SCHD stuff. So those two places, Twitter and Blossom. If you look up SCHD STAN or at SCHD ETF, you'll find me, and we can have some fun.
Yeah. Like I said, both those links will be in the description down below the video. So definitely go give Craig a follow on those things, and thank him for coming on the show. But Craig, it's been my pleasure. It's been a blast speaking to you, man. I appreciate it. Thank you.
Thank you, man. Thank you. It's been great. And I love watching your videos. I've really enjoyed your interviews, and what it made me reach out to you to have this chat.
There you go. And hey, if you also want to be on your very own episode of Dividend Discussion, at Dividend Obsession is Gmail, or Dividend Obsession at gmail.com. All these at signs are in different places. You can reach out and you can be on your very own episode. So again, Craig, thanks. It's been a blast. We'll talk to you next time. And that's going to wrap up this week's discussion. I really hope you enjoyed my conversation with today's guest, and thank you for spending part of your day with us. Remember, if you want to be on your very own episode of Dividend Discussion, make sure you reach out via email at dividendobsession@gmail.com, and I'll be in touch. But until next time, see you.